This week, let's take a look at the broken wing butterfly option strategy on SPX. This strategy is a little advanced, but I'm going to break it down in layman terms in nice small bits. So first, I just want to explain the strategy itself and why I wanted to backtest it on the SPX. And then we're going to analyze the backtest results from February. Hey, this is Rochelle, and welcome to Multiple Passive Streams of Income. So, what is the broken wing butterfly? It's a four-legged option strategy where we will buy two options and sell two options. The broken wing butterfly can either be all puts or all calls, and the choice we make is dependent on the direction we believe the asset will go. Now, if we're bullish, we will buy a put broken wing butterfly, and if we are bearish, we will buy a call broken wing butterfly. So let's take a look at the setup of a broken wing butterfly on February 25th on the SPX at 11:30 a.m. Now, at that time, I felt bullish about the SPX. The put broken wing butterfly is the bullish strategy. So the price at that time was 4359.67. So to implement the put broken wing butterfly, I would first look at the two strike prices that hug the current price of 4359.67. And that would be the 4355 and the 4360 strike prices. Since this will be a put broken wing butterfly, we will buy one put option at 4360, which is the higher strike, and buy two put options at 4355, which is the lower strike. And next we need to buy the broken wing part of this. So since this is a put broken wing butterfly, I will need to buy one put contract 2 strikes away to complete the trade. So I'm gonna buy one put contract at 43.45. So if the price is above 43.60, all the options expire worthless and the trade keeps the credit received when we entered the trade, which is $140. Now, how is this determined? If you multiply $15.10 by 2, and that's the price of the two put options that we're selling, you get $30.20. And then we would subtract the $17.30 and the $11.50. That was the price of the two put options that we bought. And that will give us a total of $1.40 times 100, which is one contract. And that would total $140. Let's take a look at the margin that we need, aka the buying power, the money that we need to have in our account to make this trade. So for this trade, we're going to need $860. And that's calculated by taking the value of the largest spread in the broken wing butterfly. So that's the difference between the 43.55 strike price and the 43.45 strike price, which is 10 points. If we times that by 100, because that's one contract, that would be 1,000. We minus the cost of the trade, which is a $140 credit. So we would need $860 in our account to make this trade. Next, let's look at the max profit of $640 and how that is determined. To calculate this, you add the cost of the trade, which is a $140 credit, to the smallest spread. So that's the spread between the 43.60 and the 43.55 strike price. So that's actually 5 points times 100, which is 500. And then if we add that credit of 140, that gives us the 640 maximum profit. Now, this is the beautiful thing about the broken wing butterfly. It allows you to make additional profit if the price settles close to the short strike price, which is the strike price that we're selling the two puts at. So in this example, that's the 43.55 strike price. So if our movement prediction is wrong, we may still be able to make some additional profit from being wrong if that price settles close to that short strike price of 43.55. Conversely, to calculate the max loss, we will need to subtract the cost of the trade, which is the $140 credit, from the smallest spread, which is the spread between 43.55 and 43.60. That's 5 points times 100. So 500 minus the 140 will equal 360 as our max loss. Lastly, let's compute the break even for this put broken wing butterfly. Take the short put strike price of 4355 and subtract the maximum profit per share, which is 640 divided by 100. So that would be $6.40. We would subtract that from the 4355 strike price, and that would total $43.48.60. Now, obviously, we do not have to calculate these numbers, but it's always good to understand how they are calculated. Your trading software will make these calculations for you, as you see on the screen. These are the results of the execution of the trade that we were looking at on the ThinkOrSwim trading platform. Now let's look at the backtest rules. I wanted to backtest the broken wing butterfly on the SPX weeklies because the SPX is cash settled. It's very liquid. We can trade it with a small account. The broken wing butterfly has a higher probability for profit because it collects a credit from the trade, and there's a small possibility to gain additional profit if the price settles near the short strike price. The SPX weeklies expire Monday, Wednesday, Friday, so it's going to give us a good amount of trades per month. And the only time they don't expire on Monday, Wednesday, or Friday is if there's a holiday in the week. And the only thing that kind of sucks is that Robinhood doesn't offer SPX weeklies at this time, but it can be traded on other platforms like ThinkOrSwim. So I'm using the on-demand backtester on the ThinkOrSwim platform, and I'm determining the SPX sentiment by looking at the SPX weekly on the day that it expires. And what I'm basically doing is just letting the market shake itself out. And when the SPX has formulated a direction, I'm using that belief to determine whether I'm bullish or bearish. And then from that sentiment, I'm determining the type of broken wing butterfly I'm going to utilize that day. So we're only in the trade for less than a day. If I'm bullish, I'll implement the put broken wing butterfly, and if I'm bearish, I'll implement the call broken wing butterfly. So now let's look at February's results. The first SPX weekly of February occurred on Wednesday, February 2nd. At 12:30 p.m., the price was 4565.39, and I was bullish that day. To execute the broken wing butterfly trade, I needed to execute the put broken wing butterfly. So that means I needed to sell 2 puts and buy 2 puts. I first wanted to hug the current price of 4565.39. So to hug the current price, I selected the 4565 and the 4570 strike prices. And since this is a put broken wing butterfly, I need to buy the strike that's 10 points below the lesser of the strike prices, which is the 4565. So I'm gonna buy the put 4555 strike to complete the trade. And on the screen is the SPX option chain in ThinkOrSwim at 12:30 p.m. on February 2nd, which highlights the strike prices used in the example. Now, in a future video, I will demonstrate how to backtest in ThinkOrSwim using the on-demand backtester. So if you'd like to see that content, please let me know in the comments below. Once the video is created, I'll add the link to the description below also. So the price on February 2nd at the end of the day settled at $45.8908, which was higher than all the strikes of the put broken wing butterfly, right? Remember, we were bullish that day and we were correct. So that allowed all of the option legs of this put broken wing butterfly to expire worthless, allowing us to keep the credit of $150. So let's look at how this panned out for the month of February. I will slowly display each back-tested SPX weekly trade in February, and each slide will show you the sentiment of the trade. Which broken wing butterfly trade was chosen based on that sentiment. It's also going to show you the time of the trade information at that time, and the results of each trade. And you can pause the video if you need to examine any of the details of any specific trade. Although I believe the backtesting results, I believe I found the discrepancy on the February 16th backtest trade. I was bearish that day at 1:30 p.m., which called for a call broken wing butterfly. The price closed higher that day, which should have resulted in a loss of $325 because I was bearish, but the backtester shows a $130 win, which I don't think is correct. So, if I'm correct in what I believe about this glitch on February 16th, let's just take a look at how February panned out. And it looks like February would have been pretty profitable trading the broken wing butterfly strategy on the SPX. The trading fees for options on ThinkOrSwim are 65 cents per contract. Since we are trading 4 contracts daily and letting the contracts expire, that's 65 cents times 4, which is $2.60 daily. And there were 12 SPX weekly trading days in February. So if we calculate all that, we basically would have paid $31.20 in fees. So as you can see, the strategy in February may have allowed a small account to almost double itself in a month, as you can see on the screen. So my plan is to continue to backtest this broken wing strategy for the month of March. And if it continues to go well, I may just do this live in April. If you like this strategy and want to learn more about it, I added a link to the description below to an informative online resource detailing the broken wing butterfly, and this resource was created by Tasty Trade. If you find this content to be useful, please give it a quick like. Please also comment about the content. All interaction helps the channel. Subscribe and hit that notification bell if you'd like to see more content like this. As always, thanks for your time, as I know you could be any other place right now. Take care.